Hello and welcome to this seminar. And basically, I'd like to welcome you all. And my name is Richard Luck, and many of you may have heard of me. I'm basically involved in quite a few money-making projects out there, including stock market trading, property investing, online businesses, and betting and sports trading and so on. Okay, so I am involved in quite a few different things. So welcome to this webinar. This webinar will last approximately sort of 75 to 90 minutes. So get ready, make sure everything's correct and you've got all your things together. I'm just adjusting the microphone as I speak. So let's get ready to go. All right, so basically what we'll be looking at is empowering investors to achieving financial success and happiness. Now, how would you truly feel if you could be in control of how much money you can make, never have any financial stress for the rest of your life, buy whatever you want for those closest in your life, spend more time with your partner and children, go on holiday anywhere in the world whenever you wanted to? So how does it feel and sound to be in total power of your life? Now, by experiencing all of this, where would you see yourself in 5 years' time? Okay, so just give that one or two moments there to really do this exercise because it's very, very powerful. Many of you will be aware of the power of visualization. So if you can see yourself in 5 years' time, where would you like to be? Okay, so do not settle for second best again. Aim to be the best each and every time. Okay, now for those of you who are seasoned stock market investors, you've probably heard of a few of the traders, popular traders out there, such as Warren Buffett, Larry Williams, and Joe Lewis, okay, who's a very popular currency trader. Now I believe he's a major stakeholder in Tottenham Hotspur Football Club as we speak. Now with trading, as you know, you can make a great, fantastic first or even second income from trading, whether it's trading full time or even trading 1 or 2 hours per day or even 1 or 2 hours per week. Okay, so you can imagine what the lifestyle would be like. Imagine playing golf in your favorite golf course around the world, or perhaps shopping in Paris, or even a trip to New York. Okay, so these are the things that you can be able to do by trading the stock market. Okay, this is what you'll be learning in this webinar. First of all, we'll be looking at what different types of investor trade in shares. We'll be looking at the FTSE 100 and some of the overseas markets. How to control shares for only 10% of its value. Which shares to trade for maximum profits and minimal risk. When to buy shares and when to sell them. How to bank enormous profits as share prices go down, so you make money as share prices fall. How to make a regular income on your shares month after month. How to analyze the most powerful chart patterns to maximize your returns. The easy, simple steps to becoming a self-made millionaire investor. Now, before we go on, just a quick disclaimer. I'll be reading this quickly and in full. So without limiting the rights under copyright, no part of this guide may be reproduced, stored in, or introduced into a retrieval system or transmitted in any form or by means that's electronic, mechanical, photocopying, recording, or otherwise without the prior permission of the copyright owner of this material. Trading stocks and options has huge potential or large potential rewards, but also large potential risk. Stock market investing is not appropriate for all investors. You should be aware of these risks and be willing to accept them before investing in stocks or options. Past performance and any examples of testimonials cited is no indication of guarantee of anticipated future results. Individual results will vary and cannot be guaranteed. The information presented at this webinar and in this guide is for educational purposes. Any examples used are for educational and illustrative purposes only. We do not recommend particular stocks, bonds, options, or securities of any kind. The names or any firms of stockbrokers, stock exchanges, financial institutions, financial planners, bookmakers, or financial websites mentioned in this seminar are for illustrative purposes only. The decision on which firm to use, if any, is at the total discretion of each individual person. Okay, I'm not going to go through the rest of them, but basically what we're trying to say in this particular webinar is all the examples used are for is basically past information. Okay, so there's no guarantee of future profitability and there is risk involved when trading financial instruments. Okay, all right, so basically what we want to do is live an extraordinary life, not an ordinary one. Okay, knowledge is power and power is success. We all know that if you want to get ahead in life, really you've got to have the knowledge. That's the main thing. This was an article by the Evening Standard quite some while ago, but basically Britain's pensions crisis is prompting thousands of employers to lift retirement ages, raising the prospect that millions will have to keep working into their 60s. Now, the changes mean that someone who retires at 60 will receive a less generous pension. Pension schemes are prime candidates for cutbacks for firms eager to cut costs. Okay, so not even our pension schemes is necessarily going to be enough for our retirement. And here's an article in the Motley Fool, the Great British Pension Scandal. I'm not going to go through all of it, but basically the highlighted area is Don was looking forward to a happy retirement armed with £25,000 tax-free lump sum plus a pension of around £250 a week. However, he predicts that he'll be lucky to get even a fifth of this, a mere £50 a week and no tax-free cash. What's more, Don is 60, so he's got 5 years to wait before he receives his basic state pension. Okay, so as you know, as you are aware, especially if you do listen to the news, the pensions is not a great way that's going to make money. Okay, now the great thing about trading the stock market, you can do it on your PC or even on your laptop anywhere around the world. Okay, so that's what technology has done for us. Okay, now if we look at some of the rates of return that you can get, as you know, in your bank, if you were to leave your money in a bank account, you'd probably get 2 to 3% per annum, which is not great. Okay, in fact, many of you right now in this current economic climate would probably be getting a lot less than that. Now, with the UK stock market, it is worth well over £100 billion. Okay, that's a lot of money. Okay, in fact, between 1970 and 1996, £10,000, if you left that in a bank, would be worth 13,000 over that 26-year period. £10,000 invested in the stock market would have been worth £51,000. So you can see how trading in the stock market can be much more viable than leaving your money in a bank account. Okay, in the UK we have well over 2 million online traders. These stats were taken quite a few years ago, so over 2 million, and it's growing very fast in the UK. In Europe, in fact, it's over 15 million online traders. In the stock market in the USA is worth over $20 trillion. Okay, there's well over 30 million online traders in the US, and over 1.2 billion shares are traded every single day. Okay, so the stock market here, both here and in the US, is huge. Okay, successful traders. Many of you may have heard of Warren Buffett, as I mentioned earlier. He turned $10,000 into $18 billion, and he did that in just 30 years. Okay, his estimated net worth is over $43 billion. Okay, that figure will vary from year to year, but $43 billion the last time we checked. Joe Lewis, if you remember him, a very famous currency trader, now a big stakeholder, of course, in Tottenham Hotspur Football Club. According to the Sunday Times Financial Rich List in 2013, he was the 20th richest person in the UK, okay, worth $3.2 billion. Okay, he in fact paid Tiger Woods $1 million just to play a round of golf with him. So that's what the power of money can do. Going on to more successful traders, Richard Dennis turned £150 into £300 million. Okay, so this is what we need to focus on. We need to focus on being the top 10%. That's what those traders were. They're in the top 10% because 90% of traders out there lose. Okay, so we want to focus on the top 10%. Now, timing is critical in the stock market. Here are just some formations and indicators that some of you may be aware of. We'll go into these a little later on in the webinar. Okay, so let's put it this way. If you were not feeling particularly well, okay, let's say you woke up one morning and you were feeling ill, who would you go to? Would you go to a financial advisor or would you go to a doctor? Okay, it may seem a simple question, but obviously the answer is would go to a doctor. Why? Because a doctor is a specialist in his field and will obviously have what it takes in terms of the knowledge to make you feel better. Okay, so it's an important point I want to draw on here because I've spoken to quite a few people, some of them attendees to our courses, and basically you find that a lot of them are quite newbies. Some of them have actually been trading as well for 10, 15 years but have no clue what they're doing. So the point I'm trying to make here is that knowledge is absolutely key. Okay, so by having knowledge, we're placing the odds firmly in our favor. Okay, again, we've got these two targets here. So which target would you choose? Would you choose this one here on the right hand side, or would you choose this one here on the left, aiming for the gold bit in the middle? Okay, we'd be aiming for the goal for this target here on the right because it's a much bigger target to hit, and that's basically what we're trying to do in stock market trading. We're trying to aim for those shares or those markets which will yield us the biggest returns. Okay, many of you may have heard of the power of compounding. Going back to Warren Buffett, he described the power of compounding as the key to wealth. In fact, in 1 year alone, 1973, Warren Buffett turned $9.7 million into over $600 million due to the power of compounding. Okay, that's an 18.7% compounded growth according to the Washington Post. Okay, so let's look at £10,000 now invested over a 15-year period. At 5% compounded growth, £10,000 would be worth £20,000. So not bad, it's doubled, but over a 15-year period. 10% compounded, £10,000 would be worth £41,000, and at 30% compounded growth, £10,000 would have yielded well over £500,000. Okay, so that is the power of compounding, and for those of you who are experienced in stock market trading, we know that that is exactly what we're trying to achieve. Okay, so this is what we'll be looking at. We'll be looking at where shares are traded, how we deal in shares, what type of investor trades in shares. We're looking at some of the stock markets around the world and powerful advantages of trading shares. So let's go into that now. So just quickly, for those who are quite new, we're just going to be covering some basic stuff over the next few minutes. So where are some shares traded? Well, in London, or in the UK, I should say, shares are traded on the London Stock Exchange, known as the LSE. Okay, that's a place where you can buy and sell shares. A stockbroker will act as the middleman between you, the investor, and the London Stock Exchange. And at the moment there are well over 2,500 listed shares. So an index. Now an index is basically a basket of shares. So the most common, of course, is the FTSE 100. So the FTSE 100 consists of the top performing 100 or the most valuable 100 shares in the UK. Okay, they're what's known as the blue chips, if you like, of the UK stock market. Okay, and the FTSE basically stands for the Financial Times Stock Exchange. And this is an example of the FTSE 100 chart taken quite a while ago, but as you can see there, between 1990 and 99, the stock market rose from 1,967 all the way up to 6,950, and that's over a 9-year period. Okay, that's a huge, phenomenal growth of 353%. That's not bad. Okay, between 1999 and 2003, however, the stock market crashed. Okay, from 6,950 all the way down to 3,250. That is a whopping drop of 53%, and that's just over a 4-year period. So where can we find share prices? Well, we can find them in newspapers such as the Financial Times. We can find them in certain investment magazines out there, financial websites. And of course, there's certain stock market software. If you do use that, you can find out some of the prices there as well. This is just some of the basic stuff that we're covering, and we'll get into the more complex stuff a little later into the webinar. Okay, now there are two types of traders. The first is known as the institutional traders. So these are the top large finance companies who trade billions of pounds. The other trader is the private traders, such as you and myself. So we invest for ourselves, and as a total, we invest just millions of pounds, which is a very small sum compared to the institutional traders. And we'll get on to why a little later on. Now, there's two main types of analysis you may have been aware of. One is known as fundamental analysis, and this involves studying company accounts, looking at dividends, the price to earnings ratios, and the earnings per share, and so on. And some traders do like to look at this because it gives you an idea as to whether a share is either overvalued and is due to come down in price, or undervalued and is due to go up in price. So some people like to look at this. Personally, I don't look at any fundamental analysis. I simply use charts, which is known as technical analysis. Okay, so technical analysis is looking at the chart of a company's share price. By doing this, we can get a study of the past performance of the share price and get an accurate prediction of what we think will happen next. Okay, and we'll cover that towards the end of this webinar. Now, what is the UK stock market made up of? Well, first of all, we've got the share. Now, a share will be basically placed into a sector, which will be placed into an industry, That industry can make up part of the index, and that in turn, sorry, will make up the stock market. Okay, so those are the different levels, if you like, of the stock market. Some of the stock markets around the world, the USA, of course, one of the biggest in the world. This trades on the New York Stock Exchange. Some of the indices involved is the Dow Jones 30, the S&P 500, and the Nasdaq 100, which consists of technology shares or technology companies. Now here's a chart of Lloyd's TSB. Now you can see we're just going to look at some of the returns you could have made in the stock market. Between 94 and 98, Lloyd's went up in price from £2 to £10.20. It's a phenomenal rise. That's a 510% return in just 4 years. These are just buying shares and it's just leaving them. Okay, so £10,000 investment there would have turned into £51,000. Rolls-Royce, between March of 03 and May of 04, that's just over a year, Rolls-Royce went up from 70 pence to £2.40. That's a 343% return. So £10,000 investment there would have yielded, or would have turned into £34,300. British Airways, between March of 03 and March of 04, so exactly 1 year, British Airways went up in price from 90 pence to £3.40. That's a 377% return. So a £10,000 investment there would have turned into £37,700. Okay, Antofagasta, a mining company, between 1999 and 2004, 5 years, Antofagasta went up from £1.59 to £12.50. That's a huge rise of 786%. Remember, that's just in 5 years. So a £10,000 investment there would have turned into 78,600. Very nice. Okay, certainly better than leaving your money in the bank account. Vodafone, one of the biggest companies in the UK, between 1996 and the year 2000, went up in price from 47 pence all the way up to £4. Okay, so that's a huge increase of 850%. So a £10,000 investment there would have yielded or returned £85,000. If we go to some of the stocks, for those of you who do like to trade stocks in the US, Ask Jeeves went up from $67 to $190. That's a 283% return. So a $10,000 investment there would have turned into $28,300. And that's just in 3 weeks. Okay, so for those of you who are aware of American stocks, you know that they can move up and down very, very quickly. They're much more volatile than trading on shares in the UK. Another stock is Broadvision, went up from $30 up to $192. That's a 640% return. So a $10,000 investment there would have yielded or turned into $64,000, and that was just in 5 months. If we look at Amazon, we've all heard of Amazon, a very big company around the world. We tend to go there. I tend to go there first in most purchases, but you can see that Amazon went up in price from $16.67 to $221. That's a 1,325% return. So a $10,000 investment there would have turned into $132,500 in less than a year. Just 11 months. That's Amazon. Okay, so the main advantages of trading shares: we can get higher returns than simply leaving our money in a bank account. We have more direct control of our finances. Okay, it's very simple to understand. There's a proven history of good long-term growth, and of course we all get the chance to retire a lot earlier. Okay, so certainly better than leaving your money in a pension pot, potentially anyway. So this is what we've covered. We've covered 1, the advantages of trading shares; 2, where shares are traded; 3, how we deal in shares through stockbrokers; 4, what type of investor trades in shares; and the huge returns that we can make by trading in the stock market. We've covered this very briefly, by the way. I'm going through it quite quickly because I do understand we do have different levels of investors, those who are complete beginners and those who are a bit more experienced. So I am trying to get through this, and I'm also got a bit of a time limit as well. So I hope you can follow me. If you do need to go back and backtrack some information, simply go back and watch this from the start. Okay, now many of you may have heard of penny shares. Okay, these are basically smaller companies with large growth prospects, but they are higher risk. Okay, so these are the very small companies, and basically they do have the potential to either make you a fortune or make you go bust. So just be aware of penny shares. Many of you may have heard of QXL. It went up in price from 10 pence to £7.44, and that was within the space of just 1 year. Polypec, I'm sure many of you have heard of this one. It went up in price from 9 pence to £35. That is phenomenal, and that was just in 3 years. Okay, so just beware with penny shares. There are two rules I always tell our attendees, and basically that is to only commit small funds and just look at it as a bit of fun to trade with, so fun money to play with. Okay, do not risk your entire investment on penny shares. Okay, that is one thing I would suggest. Okay, now we're going to cover something called options trading, and I was a former a futures and options broker, if I can get the words out. A former futures and options broker, and also have experience of trading in options as well. So this is what we're going to be covering in this section here. We're going to be looking at what options are, what type of investor trades in options, the two different types of options, which is calls and puts. We look at how to make money as share prices crash. That's right, you can make money as share prices fall. And we're looking at some of the examples of returns as well. Now, many of you may have heard that options are risky, for those of you who have heard of options. Basically, if you know what you're doing, options are not risky. Again, in anything in life, if you do have the knowledge, the expert knowledge, you can turn potentially what many people would deem as risky or risky investments into profitable ones. Okay, according to the London International Financial Futures and Options Exchange, otherwise known as LIFE, they described options were originally developed in order for investors to protect their investments and manage their risks. Options involves high return and low risk trading applications, again if you know how to trade them properly. Whilst options are perceived as complex or confusing, the reality is that the principle of options is no more difficult than that of the share market. If used correctly, options can be powerful investment tools that provide many advantages, including high liquidity, low transaction costs, and most importantly, leverage. Okay, leverage, we used an example of the power of compounding. That's an example of leverage. Okay, I will go into a different type of examples. Okay, so who trades in options? Okay, it's those people who basically want high liquidity, small capital requirements, and the potential to generate a consistent income on their shares every single month. Those who want to make money as markets move up, as markets move down, and even if the market moves sideways, you can make money trading options. Those who want to leverage their profits, and basically those who want low risk and of course the potential for very high returns. Now, options is basically the right to buy or sell shares at a particular price by a fixed date in the future. I'll say that one more time. The options is the right to buy or sell shares. Okay, you don't physically buy or sell, you have the right to buy them at a fixed price by a fixed date in the future. Now, look at this property. Now, let's just imagine that this property was worth, let's say, £500,000. Okay, now, I'll just backtrack a little bit actually. Let me just quickly go back. Okay, we'll just continue as normal. Okay, now let's say that property was worth £500,000. Now, instead of actually buying the property outright at £500,000, you could actually have the right to buy it. Okay, so you don't actually buy it; you have the right to buy that house. Sorry, at £500,000. Now, let's just say, okay, and basically you pay only a fraction of the full fee. So you pay only 10%. So you don't put up £500,000, you put up just £50,000. Now let's say the price increases over, let's say, a year or so to £1 million. Okay, you would now take up the right to buy the house at £500,000. Okay, so even though the house has now gone up from £500,000 to £1 million, you can still buy the house at £500,000. Okay, and then you can sell the house immediately to person C, that's another person, for £1 million, which is the market price. Okay, your profit would be £500,000. Okay, so your initial outlay was £50,000. Remember, you didn't buy the house outright, you simply bought the right to buy the house. Okay, so instead of putting up the market value, which was £500,000, you put up in this example 10%, which was £50,000. But that £50,000, remember, controls a £500,000 house. So I hope you understand that concept. So that 10% literally controls 100%. Okay. Now the price rose up in price. In fact, it doubled in value to £1 million. Your profit is £500,000 because remember you had the right to buy at 50,000. You took up your right to buy at £500,000, so your profit is now 500,000. Okay, so your rate of return is actually 1,000%. Okay, now because basically you've turned a £50,000 initial investment into £1 million. Okay, now that is just a very simple example. Options are just a little bit. I need to explain it more in detail, and that's what we do on our training. But basically what it is that we just wanted to cover this because it's very generic. Okay, there's a lot more involved than that, and rate of returns can be as high as 1,000, but it can be a lot less, and we'll go into that a little later. The only reason why I brought that up is because I want you to understand the basics. So if we can assume, let's before we go any further, if we can just take an example of, let's say, a Mars bar. Okay, so instead of buying a Mars bar, which is currently selling in the newsagents for 50p, we can have the right to buy a Mars bar for, let's say, 5p. Okay, so instead of buying the Mars bar at 50p, we take an option on the Mars bar to buy it at 50p, and we pay 5p for that privilege. Now, let's say Mars bars over the let's say 3 months went up from 50p to 75p. Okay, so it's actually gone up 50% in value. That 5p, remember, controls a 50p Mars bar. Okay, so what we could do now is actually buy the Mars bar at 50p, okay, for which we paid 5p for that privilege, and then sell it straight away on the market for 75p. Okay, so you've made a 25p profit on the Mars bar, minus obviously your 5p that you've paid, so it's a 20p profit. I hope that makes sense. If not, don't worry about it. Like I said, I'm going through this quite quickly. You can simply rewind this and go through it again, but we do cover it in more detail in our training, and the reason why I'm covering it quite quickly is because I do want to make sure this webinar doesn't stretch out to 2 hours or anything like that. Okay, so just bear with me. Okay, so basically there are two types of options. One was known as a call option, which gives you the right to buy shares. Now you only do this if you believe that the price will increase in value. Okay, so you're buying call options when you believe that share prices will go up. So let's look at this first scenario involving shares. Okay, so you buy 1,000, let's say, company ABC shares at £1. Your total outlay, if you were to buy shares outright, is £1,000. So we're looking at, so this example is looking at the actual physical shares themselves. So you bought 1,000 company ABC shares, they're priced at £1 each, so your total outlay is £1,000. Now let's say over a period of time that the price increased from £1 to £1.50. Okay, now you decide to sell these 1,000 shares at £1.50. You make a £500 profit. Okay, so you basically your initial outlay was £1,000. You've now sold them for £1,500. So you've made a £500 profit. That's a 50% return. That's very good. Okay, very good in the stock market. Now let's look at scenario number 2, which is involving options. So you're basically looking to buy options on that particular share. So what you do here, in this example, you'd buy one call option. In the UK, one option controls 1,000 shares. So instead of buying the shares in our first example outright, you'd simply buy one call option. This gives you the right to buy 1,000 shares. So you're not buying 1,000 shares, you're simply buying the right to buy those shares. Okay, so you've got the right to buy 1,000 shares at £1. Your total outlay could be, let's say in this example, just to keep the numbers simple, £100. So that £100 controls £1,000 worth of shares. Okay, I hope that makes sense. Okay, now let's say the price still increases from £1 to £1.50. You can now sell these once the share price reaches 150, and you've still made a £500 profit. But remember, what was our outlay? Our outlay was basically £100. So you've made a 500% return. Okay, in the first example trading shares, you made a 50% return. In this example trading options, we've made a 500% return. Okay, it's a very simple example. I'm trying to make it as simple as possible, but remember, returns like this is usually a lot less than this, but I just need to get the concept of options across to you. Okay, so let's look at some examples here. BP between February and May 2004 shot up in value from £4.15 to £5. Okay, the shares actually went up in price by 20%. Okay, now it did this within a matter of months. Okay, if you traded call options on BP, you probably most likely would have made more than 20%. Okay, so we'll look at this example. So you buy 1,000 BP shares at £4.15. Your total outlay is £4,150, okay, for 1,000 BP shares. So you sell those 1,000 shares once it hits £5. You've made a 20% return. Okay, so basically it's now worth £4,980, which is an £830 profit. Not bad in a few months at all. Okay, now let's say instead of actually buying 1,000 BP shares, let's say you bought the option on BP shares. So you bought one call option. Your total outlay was not £4,150, it was actually just £170. At £5, you'd close out your position. Your return could have been, this is just an example, of £1,020. Okay, so that's an £850 profit, but remember it's a 600% return. Now, is it possible by trading options to make returns like that? Yes, it is. For most traders, it's a lot less than this. Okay, and we'll go into that a little later. But I just want to draw the example of how options work across to you. So, for instance, Vodafone between 1996 and 2000. Remember, it went up in value from 47 pence to £4. You would have done very nicely on the options there. Lloyds TSB, within a 4-year period, went up from £2 to £10.20. These are all the examples I brought up earlier. So on the shares, you would have made a 530% increase. In the options, you could have made more. Ask Jeeves in the US went up in value from $67 to $190 in just 3 months. If you were to trade call options on Ask Jeeves, you could have done very nicely indeed. Okay, just a quick thing, just to get across to you. If you do trade options on US shares, just remember that they control 100 shares. In the UK, it's 1,000 shares. In the US, you control 100 shares. Okay, so nice money to be made there. Broadvision went up in value from $30 to $192 in just 5 months. Okay, so again, on options, trading call options, you could have done nicely there. Okay, now what you could do is, instead of buying options, you can actually sell call options. Now you do this, basically what you're doing by selling call options is giving somebody else the right to buy your shares. Okay, it's what's known as a covered call strategy, and basically it's the equivalent of earning high rates of interest on your shares every single month. Okay, so let's do a quick quiz at this juncture. If you do need to relive anything, please go back. I am going through this quite quickly, but this is a quick quiz. So when would you buy a call option on a share? Okay, so when would you buy a call option on a share? Remember, there's two types of options, calls and puts. Okay, so we buy basically options on a call option when we believe the share price will go up in value. How many shares does one call option contract control? I've already just covered this. In the UK, it's 1,000 shares. In the US, it's 100. What is the name of the strategy given when you give somebody else the right to buy your shares? It's covered call. What golden rates of interest can you expect to generate every month by selling a call option? It's about 5 to 10%. Okay, again, that figure varies. It can go a little bit higher. For most traders, it's actually less, but typically I'd say 5 to 10%. And approximately what percentage could you expect to pay by trading a call option rather than buying 1,000 shares outright? And in this example, we've used 10%. Again, that figure can be a little bit more. It can, in most cases, actually you pay a lot less than that. Okay, so it depends what shares you're trading. Now, many of you may have heard of a concept called shorting. Okay, and what shorting basically is making more and more money as markets fall. For those of you who have experience in shorting, for instance through spread betting, you'd know exactly what I'm talking about here. Through spread betting, you can make money as markets go up in value as well as when they go down in value. Okay, I know quite a few traders who really like it, actually make a lot of their fortune as markets fall. Okay, so this is a great way, and if you're doing spread betting or even futures trading, options trading, you can do so this way. Okay, so shorting is making money as share prices go down. So in this example, with a share loss, £10,000 invested in firm XYZ shares. If a share price falls from £10, let's say down to £6, if you invested the actual shares themselves, your £10,000 investment would now be worth just £6,000. That's a massive 40% loss. Okay, that's just by if you held the shares outright. Now what you could do, we've already covered call options. Put options is the right to sell shares at a particular price by a fixed date. Okay, so remember, call options in our earlier example was the right to buy shares. Put options are the right to sell shares. Okay, so in this example, if the share price was £10, what you could do is buy one put option, which could cost you, let's say, £300. And that means basically you've got the right to sell those 1,000 shares at £10. Now, you don't need to actually physically own the shares. I'm just giving an example if you do own the shares. And this is a great strategy to do. So let's say the share price does fall, as in our example, to £6. Your return could have been, okay, this is a hypothetical example, £2,300. Okay, so your profit is a whopping £2,000 because it cost you £300, but you made a profit of £2,300. Okay, it is a hypothetical example. In most cases, it would probably be less, but we actually don't have the figures on hand because they are not recorded as I speak. Okay, so but that is the kind of profit that can be made. A lot of people. That's a rate of return, by the way, of 667%. There are traders who have made a lot of money as share prices have fallen, as the FTSE has fallen. So remember, you can trade options on the index itself, on the FTSE 100, even on the Dow Jones 30. You can trade options on. So as the value falls, let's say the FTSE falls in value, you can make money. All right. So let's look at Marconi. Many of you may have heard of this. Between September 2000 and May 2003, check this one out. If you held Marconi shares, I actually knew someone who did. They fell in value from £62 to £2.56. Ouch. Okay, they just watched as the share value just fell and fell and fell. Okay, if you traded put options, you could have made an absolute fortune. British Telecom, BT, between 2000 and 2003 fell in value from £9.50 to just £1.50. Again, this share price just kept falling and falling over a 3-year period. That's a massive 72% of its value lost within 3 years. Again, if you owned the shares, your £9,500 investment, if you did buy 1,000 shares, your £9,500 investment would have fallen to just £1,500. If you traded a put option, by the way, on BT, you could have made some nice money. ICI fell in value from £7 to £2.10. That's a 70% drop. So if you traded shares on that, a £7,000 investment would have gone down to just £2,100. Now, please bear in mind that these examples are just to illustrate the point. If you did trade ICI, you probably wouldn't have got in that £7. It may have been less, okay? But I just want to highlight the point here. Okay, if you traded options on ICI, you could have made a fortune there. Reuters, the news agency, fell from £16 at its high to just £1. That's a huge 94% drop. So again, if you owned Reuters shares at its highest point, a £16,000 investment would have been worth just £1,000. If you traded put options on Reuters, you could have made an absolute fortune there. Marks and Spencers fell from £6.50 to £1.75. That's a drop of 73%. Again, if you traded shares in Marks and Spencers, your £6,500 investment would be worth just £1,750. Okay, if you traded put options on Marks and Spencers, you could have done nicely. Okay, just as some examples from the United States. Lucent Technology, if you traded shares in Lucent Technology, a $10,000 investment would be worth just $500 in the space of just excuse me, in the space of just 2 years. That's $100 went down to just $5 in price. Again, if you traded put options, you could have done very nicely out of that trade. Okay, so it lost 95% of its value. Rambus, in the space of 2 years, went from a high of $115, fell down to just $3. If you traded the shares on that, your $11,500 investment would be worth just $300. That's if you owned shares of Rambus. If you traded put options on Rambus, you could have done very nicely out of that. Okay, so whopping 97% of its value wiped off. Okay, like I said, put options, you could have done very nicely out of that trade. So what can you trade using options? Well, you can trade individual shares, which we've just explained. Shares from the FTSE 100 typically. Okay, you can't do it on any other shares. You can obviously trade on the US stock market as well. You can do it on various commodities such as gold, silver, oil, and so on. Currencies as well. So you can trade options on the currencies. So you're instead of buying it at its spot value, you'd be basically trading it at a fraction of the cost, but benefiting from the leverage that you can get. So you can do currencies such as the pound against the dollar. And you can even trade options as explained on the FTSE 100 index itself. So if you did want to trade individual shares, you can actually do it on the index itself. Okay, so the FTSE index could be trading, let's say, at 4,000 and goes up to, let's say, 4,200. If you traded a call option on that, you could have done nicely out of that. Okay. And let's look at a chart of the FTSE 100. Remember, between 99 and 2003, I did explain this earlier, it fell in value from 6,950 to just 3,277. The FTSE went down in value by over half. Okay, if you traded put options within that time, you could have done very nicely out of that trade. Okay, so that's an example of trading options on the FTSE there. Okay, so you can calculate the returns that you can make by trading options. Remember, you can make money as markets go up and down, and there is even a way using a covered call strategy where you can make money even if the market moves nowhere, it moves sideways. Okay, so here are the benefits of trading options. As we explained earlier, we're looking for high liquidity, small capital requirements. So instead of buying 1,000 shares at £1,000, you can actually have the right to buy those shares for, let's say, £100. Okay, so about 10% of its value. And by doing that, we leverage profits. And we can, remember, make money as markets move up, down, or even sideways. Okay, we want to generate a consistent income on shares that we do own every month. And remember, if you do own physical shares, you can actually still buy call and put options. You can also sell calls as well. Okay. Again, I haven't got enough time to cover that in this webinar. The options part actually takes up a full 1 day of our 2-day course. That's how big it is. So, but it is very easy to understand once you've got the concept. Options, low risk. And of course, the potential for very high returns. So options is a great way of making money. Berkshire Hathaway, this is what's owned by Warren Buffett, in 1999 was worth $270 million, according to the Securities and Exchange Commission. Option volumes in 2013, over 3 billion plus contracts have been traded so far. Okay, in 1 day, in fact, it had well over 16 million contracts in 1 day. It's a very highly liquid market. Okay, it's the largest in its history according to the CBOE. Okay, the great thing about options is that once you've traded them, you're going to wonder how you ever invested without them. Options are a fantastic way of trading the stock market. So briefly, let's look at what we've covered. We've looked at what options are. We've looked at what type of investor trades in options. The two different types of options, that's calls and puts. Remember, calls we trade when we believe or buy calls when we believe the share price is going to go up. We can buy put options when we believe the share price is going to go down. And we know how to make money as share prices crash. Okay, so explore further than you have ever been before. Okay, that's what trading can actually do for you. Okay, whether it's going on holidays with your partner, or buying your best and favorite car, I should say. I love Mercedes. Or going on your favorite holidays as well, relaxing on the beach. Okay, only you know where the road ahead lies. Okay, and you can even trade from home. That's the great thing about trading. You don't have to sit in an office. You can actually trade from home and choose the hours that you like. Okay, so those are some of the benefits of trading shares and options. We're going to look quickly now at technical analysis. And what technical analysis basically is the study of past share price information and using this to actually determine what will happen next to the share price. Okay, and we do this using charts. Jack Schwager, in his book New Market Wizards, once described the markets are not random because they are based on human behavior, and human behavior, especially mass behavior, is not random. It has never been, and it probably never will be. Okay, so what this quote basically means is that by studying uh, past information on a share chart, we can try and get a prediction as to what will happen next. And the reason for that is because when the share price actually moves based on mass human behavior. Okay, so droves of people acting together. Okay, and human behavior is always predictable. Okay, so and it usually involves greed and fear. Okay, we'll look at that very soon. Okay, so let me just quickly go back. Sorry, I just had something I wanted to cover. So basically, what it is with share prices, what we're actually looking at. Just going to go back again. Um, the very simple charting that people actually use to trade shares is basically to connect high and low points. So, for instance, in this example, you can quite clearly see that the share price is going up. This is Vodafone. So what we tend to do, basic charting suggests, is to look for low points and to connect these low points. Okay, so we can see major low is here, this point here. You can choose these as well if you like, but I'm going to choose these ones here. These are quite prominent, and these ones here as well. So what we can do here is actually draw a line to connect those points. Okay, so we've drawn a line from here, this point, going through this point, and we've decided to choose this point here. Okay, and you simply draw what's known as a trend line up across that, and basically very simple charting tells us that when the share price breaks this trend line, so you can see the share price is here and actually falls below this line, then we actually go short. Okay, so we either sell our shares or we can actually short the market. So we try and make money as the share price falls. So the further this falls, the more money we can make. Okay, you can do that using spread betting, or as explained in this webinar, we can do that by buying put options. Okay, and make money as share prices go down. Similar thing here, this is Xstrata. We can connect these points up here if we want. I'll be looking to maybe connect these 2 points up along with this one here and try and get close to this one here. So all we do is connect those low points. We can see that we've done it going across here, and basically we go short or sell the shares once the share price goes below this line here. Again, we've got an example here. So we've got the FTSE 100 index itself. You can see that over about a 5-month, 6-month period, we've connected this low point up with this low point and basically drawn a trend line. The moment that the FTSE crosses this line point here, we go short. Okay, so we believe the FTSE will fall further. Okay, it actually went sideways in this particular example. Now, the more points that you cover, the more valid the trend line. Okay, so the more of these points that you can put together and draw a trend line which pretty much exactly connects the lows, then basically the trend lines tend to be much more valid. Okay, so you've got a much stronger signal. What you could have done in this example perhaps is maybe connected this low here up with this low and drawn a line that goes up across that. You can do that if you like, but it's always advisable to maybe connect the low points going over a slightly more longer period, okay, as opposed to just a very short term one. Okay, this is an example of British American Tobacco, which actually fell in value. So simply what you do in this example, you can see that quite clearly that the share price is going down. So what we'd want to do here is actually connect the high points. I've actually used the word to actually draw this line. This line wouldn't actually touch this line, so that's why I wouldn't do so. But basically what you draw is a line connecting this high here, potentially with this high here. So you'd go down like that, and basically what the rules are is as soon as the trend line breaks above this line, what you do is actually buy the share, okay, or buy a call option, believing that the share price will go up in value. Okay, so this is very simple charting. You can see this is a chart of Barclays, and what we've done here is drawn a trend line matching this high to this high here. Draw a trend line that goes straight down, and basically as soon as the share price moves up above this line, we buy the shares. Okay, so the most important thing I want to cover with this particular section is that we're going with the flow. Okay, that's the most important. Okay, so what I basically mean by this example is if you were, as in this picture here, in a canoe, and you're actually going with the flow of the river. Okay, you're gonna get to your destination a lot quicker. Now imagine that. Imagine actually canoeing against the flow of the river. So let's say the flow of the river is actually moving down, and you're trying to move north. You're trying to move up. Okay, you can see it's much more challenging. Okay, with charts, what we're doing is going with the flow, and the great thing about going with the flow is that we're actually trying to mimic what the large institutional traders are doing. Okay, remember earlier in this webinar I was talking about institutional traders as well as the private traders. Well, remember, as private traders, we are the small fish in the pond. What we want to do is find out what the big institutional traders are doing, because these institutions are the very reason why share prices move up and down. Okay, so we want to find out what they're doing. One of the ways to do that is by simply looking at a chart, because that chart reflects what the big institutional buyers and sellers are doing. Okay, so I hope that makes sense. So basically we want to go with the flow. And what I mean by this, very briefly again, is you only buy shares that are already moving up in value. Okay, in the previous example with this share chart, you can see that we connected the high points. Once it went above the trend line, we buy. So the share price is already moving up. Okay, one thing I always teach our students is not to buy shares when the share price is still falling, okay, because it could fall a lot further. Okay, one of the things that I've found, certainly in my experience, is traders trying to anticipate or guess where or how low the share price will go. That's just a waste of time. You don't really want to try and anticipate how low it can go before buying. Okay, you only buy shares when they're moving up, and you only sell shares when they're moving down. Okay, I hope that makes sense. Okay, so we want to go with the flow. Okay. So this is basically just a chart, and let the trend be your friend. Okay, always remember that. Okay, so if the share price is moving up, for instance, then we only want to get involved when the market goes up, unless it breaks a trend line, by which case it'll only break a trend line if it's already moving down. Okay, so let the trend be your friend. If the share price is moving up, or in this case the FTSE 100 is moving up, we only want to go long in that situation. Marconi, remember September 2000 to May 2003, went all the way down from £62 to a low of £2.56. Channeling. Now this is something which we can do. What you're basically doing is connecting the high points. As you can see here, we've connected this particular high point with this one here, drawn a trend line, and what we've done is also connected the low points as well. So we've connected this low here, and there is no such low. Well, there is a low there. You could call that a low. We could have gone a bit wider, but we've decided to do it this way. Okay, and the reason for that is because you can see that the slope of the two lines are pretty much identical. It's what's known as a channel. So what that basically means is that share price is moving up and down within this channel or within this band. And basic charting will tell you that if the share price was to move up above this line, this line here, we go long. Okay, long meaning that we believe the share price is going to go up. Or if it breaks down below this lower trend line, then we go short, okay, and make money as the market goes. Okay, this is an example of what's known as a ceiling and a floor, what's more commonly known as a support and resistance lines. Now, what it is, you'll see that the share price is moving up and down, so you can see it here moving up, down, and then up again. Now, you can see here that the low that it's reached at this point here is very similar to this one here, okay. It's reached a high there, it's come down, reached another high, which is very similar to the previous high, come back down, which is very similar to a previous low, and so on. And you will find that if you do look at share charts, this is very common. These 2 points here, it's actually showing that the share price doesn't really want to move above this line, okay, or above this price level, and it's what's known as a resistance level, okay. And similarly, you can have a support level, okay, or a floor where prices don't really want to move below this low. You also have a support level here, okay, so this low here is very similar to this one here, so this is known as a support line as well, and prices are resistant to moving lower. Okay, now the basic premise of charting suggests that prices will tend to move within this band. So basically, if you're looking to buy shares, you'll be looking at prices at around this level. Okay, as I explained before, you don't want to necessarily get in until it's at least moving up in your favor. And similarly at this level here, you can see that many investors believe that share prices probably reached their peak and are likely to move down, so they start selling, and that selling activity will lead to the share price going down, as in this case here. Okay, so it's what's known as support and resistance. The basic rules is if it does move above resistance, then it's likely to shoot a lot higher, and similarly, if the price goes below support, then it's likely to move a lot lower as well. Okay, so what you'll do, I've pretty much drawn a picture of a house here just to make it look a little bit easier, but you'll see quite a few examples of support and resistance in share prices. It just gives you an idea at key levels of support and key levels of resistance. So which prices our share prices unlikely to go any higher. And remember, I say share prices, but it could be commodity prices, it could be currency pairs, anything. Okay, so just bear that in mind. Support and resistance, very important to look at. I'm just going to quickly go through some chart patterns, some very typical chart patterns. This is what's known as a triple top. So you can see the share prices moved up, created a high here, came down, created another high, which is very similar to this one. So this would be an example of resistance. Came back down, then moved up again. Okay, it doesn't have to be exactly the same, it's moved up a little bit higher, but that gives us three tops. Okay, so we've got one top here, a second top which is known as a double top, and then you've got the third top which is a triple top. Okay, and what we tend to do in this situation is just draw a line through the major support level. Okay, so we've connected these 2 points here, and the line goes across, and as soon as the share price breaks below that line, we tend to go short or make money as the markets go down. Okay, so that's what's known as a triple top. And by the way, just a quick thing I want to mention, that the distance between the top, or the resistance if you like, to the trend line or to the support, that distance there in terms of share price will be the same on the downside. So you'll have at least a bit of a profit objective or a profit target to look forward to. So that's just something to bear in mind. Sometimes it will fall short of that, sometimes it will go beyond that. Okay. Head and shoulders very similar. You've got a first high here, so it reached a high there, came down, it reached a much higher high, came back down to a very similar support level here, moved back high, and you can see that this third high is very similar to the first one. This is what's known as the left shoulder, this is the head, and that's the right shoulder. So you've got a head and shoulders formation. You can simply draw a trend line through the major support levels. Again, once it goes down beyond this point, you go short to make money as the market goes down. Okay, you can do that via spread betting or by buying put options. Okay, three highs of a triple top, it has a very high success rate. So remember, I showed that in the earlier chart. If you do get a triple top formation, it has a very high success rate, more so than a double top. Okay. Don't worry if you don't know what a double top is. Okay, this example here is another example of a triple top. So we've got, you could call this a head and shoulders, but I'll call this a triple top personally because I'd like that high to be higher for it to be a head and shoulders. So again, draw the trend line through and measure this distance here, and basically you'd expect it to go down. It didn't go down as far, but one of the things is we've got a triple top here. If it does break on the upside above that triple top, then it's likely to go much higher, which I just explained in the previous slide. Let's just go back. So three highs of a triple top, a high success rate. So you can see you've got the three highs of a triple top here. If it breaks that line, then it's likely to go a lot higher. Okay, don't worry about these. These are what's known as pullbacks. I'll describe that in the 2-day training. But basically, if it does go up above that, it's likely to go a lot higher. Okay, just examples of charts. We have what's known as a line chart. So basically you can see that this chart is represented by a simple squiggle, just a line really that goes up and down. Okay, you also get what's known as a bar chart. Okay, so instead of having a line chart, you have what's known as a bar chart. And basically what this means is that the high point of that bar is the high for that particular period of time. So if you're looking at a daily chart, for instance, then each one of these bars represents 1 day of trading. So the high would be the high that it reached during the day, the low would be the low it reached during the day. The open is always represented by the left tick, so that's the left tick there, open for the day, and this is the close on the right side. Okay, so you can see in this particular example, the open opened higher and finished lower, so it actually lost money that day, or the market moved down. Okay, so that's an example there. You might have in other situations have an open here and a close up here, which means obviously it's an up day. Okay, so if you're day trading, if you're looking at 10-minute chart, that would be each one of these bars would represent 10 minutes worth of trading. So it'd be the high of that 10-minute period, the low of this 10-minute period, and so on. Okay, so just that's something to bear in mind, and that's exactly what a bar chart looks like. So it's not a line. Okay, it's simply bars. Okay, and this is a daily bar chart. So that each one of these bars represents 1 day of trading. Remember this example. Let's go to this example here. You can see that the left tick there is the open. Okay, and it actually opened at the low, reached a high there and closed here. So it's actually been an up day, and that's represented by the blue lines. Okay, it doesn't different charting software uses different colored lines, so you may need to look out for that. But in this example, blue means it's an up day, and red means it's a down day. Okay, so this is what's known as a candlestick. Now, these candlestick charts are the most oldest form of charts used. You can see in this example here. Let's assume this is again 1 day's worth of trading. Instead of using a line chart or a bar chart, this is a candlestick chart. So you can see we've got the high of the day and the low of the day as normal. We've got the open here. Okay, so it's represented here lower down, and it's closed higher. Okay, so it's opened lower, closed higher. It's an up day. It's represented by a white candle. Okay, and if you see basically a colored in candle, in this example it's red, it basically means that it opened higher and closed lower, so it's a down day. So instantly looking at this chart, you can tell which is up and down days. All the white lines, the white filled in areas are up days, and all the reds are the down days. Okay, so you can instantly see which are up days and down days. Okay, some of the indicators that traders like to use, one of the most common is volume. So you've got a chart there. In this case, you can see it's a bar chart, and below we've got to have some indicators as well. And this is an example of volume. And what we're looking for is for high volume. Okay, so if you notice a particular, for instance, this particular chart, it's moved lower down and reached a low there, and it's reached it, well, pretty much on high volume. I think it's just probably the chart, the bar before that, but basically that gives an indication that we're looking for high selling activity. High buying activity, and the market is likely to move up. Okay, so traders have sold at this point here and now looking to buy at that level. Okay, so we're looking for high spikes in volume. These are great. So a lot of traders do like to look at volume. Stochastics is another one. So we've got an example of a line chart there. We've got stochastics at the bottom here. Just a quick thing. Again, I am going through this quite quickly, so I do apologize for that. But basically, the very general rule is with stochastics, every time the lines move in this area here, okay, it means it's been basically overbought, and it's likely that the market will start to move down, and you can see that it tends to move down. It's not 100% foolproof. Okay, again, this lower band here, this particular area means it's been oversold, and when the lines come into these areas, it should be looking to go up, and you can see it goes up. Okay, what some traders like to do is use the crossovers. So when, for instance, the blue is above the red, then the market is likely to go up, and when it crosses below, it's likely to go down. Okay, you can see it tends to cross over a few times here, and the market doesn't tend to do much. You could actually lose money in that situation. Okay, it's what's known as whipsaws, but don't worry about that for now. But that's just an example of what traders like to use. Okay, moving averages. This is where you have a moving average, which is an average price of the last, let's say, 5 days or 10 days, depending on what you're using. If you're using a 5-day moving average, what it means is that this line, this red line here, is the average of the past 5 days pricing close. Okay, so again, very simple. What traders like to do is once price moves above the moving average line, the market is likely to move up even higher. Okay, you can get some whipsaws here again, where it moves in and out very quickly, and you get in and out very quickly and lose. You can lose a bit of money or make a little bit of money, but that's what's known as whipsaws. So not a greatest tool to use, but some traders do like to use them. Okay, so that's moving averages. We've got MACDs here, again very similar to stochastics. Not going to go into that now. We will cover this in more detail on the training. And it's an example of the FTSE 100, remember, moved up very nicely indeed. And these are just examples of key levels to look forward to. Now, previously, the key levels of the FTSE are 4,300 and 4,700. Okay, another key one is 5,000, 6,000. Usually round numbers, so 4,400, 45, 46, 4,700 are good indicators. So if it goes above 4,700, for instance, it's likely to go a lot higher. Okay, that's what again traders like to look out for. It's what's known as key levels. Some free useful sites. We've got Yahoo Finance. If you go to google.com or .co.uk, depending on where you are, type in Yahoo Finance, you'll come up with their page. You can view a lot of the news, what's going on there, as well as some free, very basic charting software. And also www.trade2win.co.uk. That's trade number 2 win.co.uk. It's basically like a forum, so you can see what people are talking about. Okay, so charting gives us tells us which direction the share price will move in, or well, hopefully move in, I should say. It tells us by how much, and it tells us by what time period as well. Okay, we'll cover that in more detail on the 2-day training. What shares the top 10% are buying. Remember, charting activity tells us what the institutional traders are doing, okay, because they are the ones that move the market. So basically, by looking at charts, it gives us an idea as to what the top 10% or the institutional traders are doing. Okay, it looks at when they are selling, and it allows us to become more disciplined. So using charts enables us to get all our emotions out of the way. Okay, and you're likely to be much more successful as a result. Now, these are the two words which I mentioned earlier, are very important for those again seasoned in stock market trading. You probably would have heard of this. It's the whole emotions of greed and fear. Okay, so for instance, a good example is when you're making money, you tend to get quite greedy, and when you're losing money, you tend to move into a state of fear. Okay, so what tends to happen in these situations? It really does have such a huge impact on your profitability as well as the way markets move. But I've spoken to traders who basically were making millions, got greedy, and ended up losing the lot because they got into so many positions, weren't able to control their emotions, and therefore traded in markets they knew nothing about. Not that you necessarily need to know much about what's going on. You can just use the charts, but they didn't use charts, and they simply went in and piled millions into the markets only to lose it. Okay, so you want to try and get greed and fear out of the markets, because greed will basically keep you into trades, into profitable trades, but which could potentially tank very quickly. And end up being a loss, and fear means you get out of profitable trades too soon. Okay, so I've seen traders do that as well. They get out very quickly, and then the share price continues to double. Okay, it does happen. So you want to get greed and fear out by using charts. It enables us to at least get some element of control over greed and fear. Okay, accelerated growth. Okay, so 1 for 1. That's not really what we're looking for. What we're actually looking for is for every £1 we trade, we want to make at least £5. Okay, that's ideally what we want. It doesn't need to be £5, it could be even £2, but we don't necessarily want 1 for 1, we want 5 to 1, and leverage enables you to do that. Quick thing on stop losses, some of you may have heard of that. Basically, if we look at a share price, you can see it goes up and down as follows. The share price has moved up to this high point there, moved down, and moved above it. Okay, so what we could do now is we could buy at that point, because it's basically broken through above a trend line. It's broken above a previous high. Okay, so we can go long here, and what we'd want to do is place a stop loss at the previous low point there. Okay, a stop loss, for those of you who are not quite aware of what a stop loss is, it basically is a trade that we place with our stockbrokers just to protect us should the share price go down. Okay, so if we continue it here, you can see it moves down and then back up again. You can see it's made another high there. So what we could do is we cancel this particular order here, and we move it up to this point here. So just remember, the share price is currently here. We bought in at this point here, and we now moved our stop loss from this initial point up to this one here. Okay, another previous low. And we can keep doing that until basically we make some money on the trade. Okay, so we move our stop loss up from here up to here. So now we're locking in this potential profit here. And then when the price goes through that level or down through that level, we can sell, get out of our position, and we can then even short if you want to and make money on the downside as well. Okay, this is a very simple stop loss strategy, very successful. I used this. I now use a different method which you'll learn on the 2-day course, but this is very simple strategies that you can use. Okay, so knowledge is key. We all know that. If you have the knowledge, it can really bring in some tasty returns. So what we've covered so far, we've looked at what technical analysis is, which is the study of charts. We've looked at shares in an uptrend, downtrend, and sideways movement. How to trade in the direction of the share price. Remember, let the trend be your friend. You only get into shares or buy shares when the market is moving up. You sell them only when they're moving down. Okay. We looked at the different types of charts. So we've looked at line charts, bar charts, and candlestick charts. We looked at different types of chart patterns. Okay, so we looked at a triple top, head and shoulders. We also looked at support and resistance. We looked at channeling. We looked at different forms of indicators, so the MACDs, the stochastics, the volume, and so on. We also looked at the elements of greed and fear. Okay. By the way, I just want to mention one quick thing. Greed and fear ultimately will determine how successful a trader you are. Okay. All these are great. Volume, moving averages, stochastic, using indicators and using charts and so on. But trust me, greed and fear is the difference between a successful trader and one that is not. Okay. Mindset is very important. Okay. And we looked at accelerated growth as well. Just an article from a London newspaper was just talking about redundancy. I'm not going to go through this because basically we're short on time. But basically, 1 in 3 fears job losses. Okay, basically the economy is not exactly getting much better. As I talk right now, it is improving, but only very slightly, and people are still worried about their jobs. So it's just something to bear in mind. This is a newspaper article. 8:15 a.m. and work for the day is over. A redundant city staff finding rich rewards on home computers. Okay, so this is a trader who basically was made redundant and started trading from home and would work pretty much, I think, about 30 minutes a day. Okay, and that was it. His work was done by 8:15 in the morning. Incredible. Okay, so remember, there's only 2 ways to trade. There's the right way, and of course, there is the wrong way. Let's look at some of the death traps of trading. So these are the things that you shouldn't do whilst trading. Okay, get involved in emotional trading. We looked at greed and fear. Get that out of your trading because that will enable you to, if you don't and you get emotional about your trades, that can lead you to making the wrong decisions. Do you not know which shares to buy and sell? Okay. There's no element of risk control, so no use of stop losses or when to get out of your trades. Some traders trade all their capital on 1 or 2 shares. You don't want to do that, that's for sure. They follow tip sheets, okay? So this is following recommendations in newspapers and investment magazines. They're probably the worst thing you can do. Or even listen to some of the investment channels. A lot of the investment channels, remember, all these analysts are not paid traders, so they basically just analyze the markets. They don't actually trade them. Those are not the kind of people I follow. Those people who go against the trend, so basically that means if the share price is moving down, some people try and guess how low it will go before they buy. You don't want to do that. Remember, you only buy when the share price is already moving up. So those people who go against the trend, you certainly don't want to go against the trend. So those who do not leverage their positions, those who buy shares simply based on the stage of the economic cycle, it can work, but it's not the best way of trying to make a living from the markets. They run their losses and cut their profits short. Again, this is going back to the greed and fear. So basically what that means is when they're making money, they tend to get out very early, okay? And basically they get a bit of fear set in, but they're happy to keep their losses, okay? So as the share price keeps going down and down and down and they're losing more money, what tends to happen is some traders think, okay, it's bound to move up at some stage. It's bound to move up at some stage, and they just keep hold of them. But the share price keeps moving lower and lower. Remember some of the examples we had earlier. Share price moved down from £62 to, I believe it was £1.50. Okay, it can literally wipe you out. So you don't want to get involved in that. Okay, do not follow strict rules. So traders who don't have rules and systems in place, you want to get that out. Some death traps always think they're right. Some traders always like to believe they're right, even when they've lost money. They have no idea how to compound their returns. Okay, according to Warren Buffett, that's the key to success, and they add to their losing trades. So what that means again is, in the previous example, I talked about a share price moving down. And what some traders like to do is keep hold of it, believing that the share price will move up. So what some traders do is actually buy more and more positions at lower prices, because as the share price does move into their favour, then their average price of their stock is lower, so they make their money back quickly. Okay, I suggest not to do that. Okay, so you don't want to add to your losing trades. Those are the things that you shouldn't be doing. Okay, there's the religious trade as well, and that's basically where some people, it's a bit tongue-in-cheek joke about this one, but basically the religious trade is those people who sit and pray that their stocks will make money. Okay, you don't want to get involved in that. Okay, if you haven't got a plan, if you don't look at charts, if you don't look at anything like that, then you really are really playing the casino on that one. So, how much are you prepared to lose before you invest in the right way for your future? At some point, you're going to get training in the stock market. If you are looking to get involved for the first time, or you are a seasoned stock market investor but not making your any returns or good returns, then at what point will you take the education? Because at some point you will, otherwise you could end up losing your shirt. Okay, investment is by far the most profitable or the best way to try and make profits from anything that you do. So let's look at some golden tips for successful investing. These are the things that you should be doing. Add to winning trades, but by a lesser amount each time. That means that if your trade is making money, then by all means you can buy some more and add to your position. This is an example of compounding. Number two, maintain risk control. So play great defense, not offense. For those who are quite familiar with American football, you want to play great defense. So basically, maintain risk control means as you go into a trade, you know the risk that you're up front that you're willing to take on that trade. Okay. Number three, it is always easier to get back in than to get out. Number four, if you don't bet, you cannot win. And if you lose all your chips, you cannot bet. Okay. If you don't bet, you cannot win. And if you lose all your chips, you cannot bet. Think about that. Number five, people's thoughts and actions will never change. Okay, it's the mass behavior that we talked about earlier. They always act in the same manner, therefore study charting. Learn how to read charts. Number six, use your head. Be disciplined. Look to build up your profits. Number seven, if you are in a signal and your trade gets stopped out using a stop loss, you can get back in if it reaches a new high. That's a simple technique to use. Do not overtrade, so don't buy like 5 or 10 different types of shares if you can't control your positions on a daily basis. Okay, so do not overtrade and never add to losing trades. If your trade is losing money, don't buy more positions. Number 9, always use stop losses. There's a way, a technique that I teach on the course itself, and do not attempt to pick market tops or bottoms. So if you think a market is a share price is going down, don't try and predict how low it will go. It's a waste of time doing that prediction game. Okay, Lloyd's TSB, remember, it moved up from £2 to £10.20. These are just some of the returns that you could have made trading the stock market. That's a 510% profit, and that's nice, tasty returns there. Antofagasta, remember, moved up from £1.59 to £12.50, and that is a whopping 786% return. Vodafone, if you remember them, they moved up from 47 pence to £4, and this is a tasty 850% return. Okay, now the reason that you have risk in your life is because you do not know what you are doing. Okay, the reason you have risk in your life is because you do not know what you are doing. Okay, basically it means a lot of traders just go in blind. They don't have any idea what shares they're trading, why they're trading them. They read newspapers and so on and start trading the wrong things. Okay, if you learn how to become a professional trader, you can learn to start making money from the stock market, minimize your losses as well. Okay, because making profits and losing money is just all part and parcel of any money-making venture. Okay, do not be scared to lose money. It's natural. But the most important thing is obviously over the medium and long term, you make much more money. That's the whole point. Okay, and that's a quote by Warren Buffett. Okay, if you don't know what you're doing, there's risk. Okay, so train to become a specialist. Time will never come back. Okay, so do not waste it. Now, it's a sad fact, but 90% of people out there model themselves off the wrong people. Okay, they listen to their friends, they listen to maybe even their financial advisors, or in some cases stockbrokers give them some incorrect information. You don't want to rely on other people, you want to get the knowledge for yourself. Okay, now it's best to have 1 year's experience trading the right way rather than 5 years experience of doing the wrong thing again and again. Okay, so if a trader comes up to me as making money, he's only been trading 1 year, I would very happily listen to that person rather than someone who's got, let's say, 15 years worth of experience but is not making money. Okay, because they just keep believing that they're doing the right thing. Okay, I'm only interested in results. I'm not interested in what people think or whether they believe they're right or wrong. I'm just interested in the results that people are getting. Okay, and that's the same thing that you should be looking at as well. Okay, the reason why I put this quote up here is because I've actually spoken to traders who've traded for over 15 years and attended my course, and basically started making money. Okay, I found out very quickly that they were doing all the wrong things, reading newspapers, listening to all the investment channels, and didn't really have an idea of what was going on. So that's something to bear in mind. Here are some facts and fiction. Fiction: the share and options market is too difficult to understand. Fact: not at all. The number of private investors trading shares and options profitably has grown considerably. Okay. Fiction: I need a high level of education or qualification to trade the stock market. Fact: anyone, regardless of age, gender, or education, can trade the stock market. Successful investors have come from doctors, administration staff, and students. As young as 19, 20 years old are looking now to trade the stock market. Fiction: I need at least £10,000 to start trading. Fact: private investors have started to join thousands of other traders and making large sums of money using as little as £100. And if you remember Richard Dennis, he started off with £150, turned it into 300 million. Okay, he's what's known as a turtle trader. I'll go into that in a second. Here's your 5-step formula for success, so please write this down. Number 1, identify the trend. Is it moving up or is the share price moving down? Number 2, identify the pattern. Is there a pattern that emerges? You could look at triple tops, head and shoulders. There's flags as well. Number 3, select the relevant indicator, whether you're using volume or MACD or whatever. Number 4, limit your losses using limited risk applications. So make sure you know in advance of going into the trade where your potential, where your basically your exit point is. And number 5, enter the trade and always look to compound returns. So enter the trade. If it's making money, you can buy more positions to compound your returns. Okay. So make your goals as a necessity, not a possibility. Okay, so here's my goals for next year, 2014. Just quickly, I've got many goals in fact, but these are just 2 of them. Experience the sights and sounds of the exotic island of Hawaii. I've yet to go there, so I'd like to do that, and contribute more time and money to charitable projects. So that's what I certainly want to look to do from next year onwards. Give a man a fish, he can feed himself for one day. You've probably heard this quote. But teach a man to fish, he can feed himself for life. Okay, don't rely on anyone else, guys, for your education. If you want to learn how to trade the stock market, you need to learn how to trade it properly. Okay, just a quick refresher quiz. I know I'm running very low on time now. So how much is the UK and US markets worth? Well, in the UK it's over 100 billion. It's going to be much more than that now. In the US, over $20 trillion. Which index does the top 100 companies in the UK trade on? It is, of course, the FTSE 100. What is the term given to a trade as you make money as share prices fall? Okay, so as share prices fall, what is the term that it's known as? It's shorting. Okay, now when would you buy a call option? When prices rise. And when would you trade a put option? It's when you believe prices are going to fall. Okay, and what type of chart pattern is this? Yeah, that's right, it's a triple top. Okay, so that's just a quick refresher on what we've covered in this webinar so far. Just a quick thing, the Keys to Riches trading course. As you know, there are courses out there who charge anywhere between £1,500 to £2,000 for a 2-day event. I'm not making those figures up. I'm sure many of you are aware of that. I have taught traders now since 2003, and I recently charged £997 for a full day, 2-day course. Now, what it is, as you know, there are companies out there who charge £1,500 to £2,000. I wanted to make sure that this is really affordable for everyone. So I recently charged £997. It was a hotel-based course for a full 2 days. You're not going to pay that, by the way, but that's how much I did charge, £997. Okay, and you will learn how to get this for over 90% off. Okay, it's absolutely ridiculous, and the main reason for that is because my costs are a lot less lower by doing it over the internet. Okay, so here's a powerful techniques you will learn very quickly now. We've only got a few minutes left. I'm going to teach you how to make money in any market direction, whether it moves up, down, or even sideways. Number 2, tip sheets and why you should never follow them. I'll go into a little bit more detail there. How the rich use the power of leverage to accumulate wealth and how you can easily do the same. How to earn £500 per day tax-free in less than 30 minutes. How to double your money, even if shares rise by as little as 50 pence, you can double your money. How to maximize your returns by adding to your trades, we've briefly covered that. How to use options effectively using unlimited profits with low risk strategies. Okay, we covered a bit of options earlier. Just want to make it clear, you're going to get the 2-day training. It's not going to be over 2 days, so you're going to get the downloaded recordings of the training. Options takes up 1 day. The other day is all based on strategies and looking at charts and all these kinds of things. Okay, so options takes up half the course, but the other half is purely looking at strategies and looking at techniques and so on. Okay, so just want to bear that in mind. So using options to hedge existing trades and to generate a regular income every single month. How to maximize your returns and start trading with only £100. That's all you need to get going in whilst trading. How to be in control of your finances at all times whilst others panic. Powerful strategies that informs you how high a share price will rise even before you enter the trade. We have an idea of how high that share price will go. That's valuable information. And a success formula that gives you a powerful advantage over other investors. Okay. The 3 R's, guys. Retain. So get the information, retain it, repeat what works, and refine it even further. Those are the 3 R's. So retain, repeat, and refine. Okay. You'll also learn an election strategy. So I'll be teaching that on the actual training as well, the election strategy. Here's the millionaire mentality. Number 1, it's not how hard you work, but it's how smart you work. Number 2, to be able to be the best at anything, you need to get the right knowledge. Knowledge is absolutely key. Okay, if you know what you're doing, you can make money. Be comfortable doing the things that others would find uncomfortable. It's what sets you apart. Number 4, if you're not making money, then you're losing the opportunity to. Number 5, the secret is to spot an opportunity and then seize it. That is the millionaire mentality. Number 6, do not rely on anyone for financial security. Not your mutual funds, not pension funds, nothing like that. It is always up to yourself. Number 7, let the money do the work for you, not the other way around. This is what the rich do all the time. Number 8, the secret of getting ahead is to get started. Number 9, some people dream of success. The rich act on it. You've got to take action, guys. And number 10, be a wealth accumulator, not a wealth giver. Okay, so these are the millionaire mentality. Now that is a picture of Monaco when I went to watch the Monaco Grand Prix recently. Absolutely beautiful, isn't it? Imagine actually living that kind of lifestyle where you can go on holiday comfortably and do exactly as you wish. Okay, an equal opportunity for an unequal world. That's what we're looking for. Okay, so how does one become a master in trading? Okay, if you wish to know the trail, inquire of those who have traveled it. So you can only get training from people who have actually done or been down that path before. Okay, so if you listen to your friends or you listen to your work colleagues, people who really haven't made money from the stock market, you shouldn't be listening to them. You're listening to the wrong people. Okay, so if you wish to know the trail, inquire of those who have traveled it. Learn from someone who has done it before. So here's the keys to riches program. I'm going to cover this really quickly. I did do a 2-day course for £997, which is incredibly valuable. I did actually have traders. This is not just a selling point. I did actually have traders who had paid £2,000 to go on other training, came to ours, and absolutely loved it. We had one trader who actually came to our course for £997, and he had spent over £10,000 going on 5 separate training courses. It was an American company, but they went on 5 separate courses, spent over 10 grand, ended up coming to ours and loved it. Okay, so some free bonuses if you book tonight. You're going to learn some powerful key strategies, the 7-step strategies for selecting trades, some simple exercises that we'll be going through, and you'll also receive our traders template on how to record your trades. Okay, so other 2-day courses, as you know, some charge £2,150. That's just a ballpark figure. £1,500 to £2,000 is the pretty much the norm. The reason why I put £2,150 because they charge about 2 to 3 grand for additional training, which I think is just not on. But anyway, our 2-day training, £997. You're not going to pay that because basically this is now recorded. The webinars we've done recently, and we've now put it into a recordable format, so you get the full 2-day training. I think it averages out at about 10 hours worth of training. It could be slightly more, slightly less, because we've had to re-record it all over again. But you can get it for just £77. That is absolutely ridiculous, guys. Okay, so you're not going to pay £2,000. You're not even going to pay £997. That's £997, which we charged before. But because now we've recorded it, and you don't have to turn up to a 2-day course in a hotel, you can get the full 2-day training for just £77. That's 2 days worth of training. Some of the bonuses you're going to get. I did mention the successful trader. Remember Richard Dennis? He turned £150 into £300 million. If you haven't heard of Richard Dennis, he was known as one of the turtle traders, and you're going to get his system, his full trading system, absolutely free. Okay, so you will learn his trading systems for free. Okay, it won't take you that long to go through maybe an hour or two, and you can learn his systems for free. Okay, you learn the 12 simple steps on how to get started. This is very key because a lot of people do actually go to training courses for £2,000, walk away from the 2-day training and have no idea what to do next. Okay, so we'll run you through that, the 12 simple steps on how to get started. You'll also learn a stock market pattern that has repeated itself time and time again, and why the next one is due quite soon. Okay, so it's a certain stock market pattern that just keeps on happening again and again. So these are the questions you need to ask yourself. We're only last few minutes now. And so, do you want to earn more money? Number 2, do you want to live a better lifestyle? Number 3, are you determined to be successful? That's the most important. Are you determined to be successful? Are you willing to do anything it takes to get what you want? And number 4, are you serious about investing? Those are the questions you need to ask yourself right now. Wealthy people are decisive in nature. That's why they're wealthy. Napoleon Hill. Think and Grow Rich. Okay, if you haven't read Think and Grow Rich, please read it. It will change your life. Think and Grow Rich, Napoleon Hill is a book. Okay, once you have this information, by the way, remember guys, once you come to our 2-day event, you'll have this information for the rest of your life. It's a one-off investment of just £77. Wow. Okay, look towards your brighter future. I want you to see it. I want you to hear it. And I want you to feel it. Okay, so look towards your brighter future, see it visually, hear it, and feel it in your heart. A quote from Anthony Robbins. I'm very big on the personal and self-help industry. Your decisions, not your conditions, determine your financial future. Your decisions, not your conditions, determine your financial future. Some more quotes. Warren Buffett, first of all. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Robert G. Allen, how many millionaires do you know who have become wealthy by investing in savings accounts? I rest my case. And a quote from Paul Clifford, invest in yourself. Your career is the engine of your wealth. Benjamin Franklin, an investment in knowledge pays the best interest. Okay, it's not just trading the stock market. Get the knowledge. That will be your investment. So this is for you if you have 30 minutes per day or even just 2 to 3 hours per week. If you want to learn more about trading the stock market, whether you're a complete beginner or have experience of trading in stocks and shares, this course is for you. If you want to make a first or second income from trading, so you want to make a full-time income or just some income on the side whilst you're in employment or running a business. If you want to learn the secret techniques and trading strategies of professional traders. I've been in the industry a long time, guys. I was a futures and options broker and a trader as well, and recently retired. Well, I say recently, probably about 3 or 4 years ago, retired. Okay, stopped doing the training for a few years to concentrate on other business projects, and I'm now going back to helping people how to make money from the stock market. So the keys to riches, guys. Click on the button below on the website. If you go to our website, you're probably watching this video on our page. On our website, you'll see the link below. Remember, we did charge £997. You can get it for just £77. You'll receive the 2 days training, the recordings of it, and basically you will be armed with the best knowledge you can possibly get. So thank you very much indeed for your time. I'm sorry if it has been a bit of a rush. Please go through this video again should you need to, but I was absolutely committed to keep this training, this webinar, below an hour and a half. Okay, so I think I've done that. So anyway, thank you very much for your time. Remember to click the button below on our webpage. You can get it for just £77. That's over 90% off. So you're paying less than 10% of what other traders have paid. Okay, so £77. We're doing this because we don't want money to be a factor. We want you to get up and going with your trading. There's no need to spend £500 on a course when you can use £500 to trade with. Okay, so our training is just £77. So thank you very much indeed, and we look forward to welcoming you soon. Thank you very much. Bye bye now.